Howdy everyone, Jacob here. So today I'm going over stock company number 2 on our dividend yield screener. Just to remind everybody, we have positive earnings growth, profitability, and over a 4% dividend yield. We're looking at ACCO Brands Corporation, a company that does commercial services and supplies. We're not looking at any heavy growth here, but valuation ratios look super cheap. Let's see, ROIC, not super great, probably below their weighted average cost of capital, so that's not creating value. Um, let's see, since 2017, 1.949 billion to 1.948, very consistent, really no growth essentially. So with inflation, it's probably negative growth. See cash flow, they've always been positive 160, 140, 140, 150, 170, 160. Looks like it's always been greater than their net income, so that's good. They're producing more cash flow than they're showing on their net income. Um, they do have a little bit of debt, quite a bit of debt, 937 million versus their current assets of 882. Quite a big difference between market and enterprise value. That's going to be their net debt to short-term cash and cash equivalents. Let's look at making some assumptions here. Oh yeah, I forgot. So 30 cent dividends. So that's a 6% yield. Pretty big for if you're in retirement wanting some dividends that could possibly also appreciate. So um, let's see what we got here. All right. Yeah, that's good. That's good. Okay, so let's make some assumptions. So revenue. Oh, geez, dude, I might do zero here. I mean, we're not looking at any revenue whatsoever. Some with zero revenue should have roughly a 10 price to earnings, 10 to price to free cash flow, since the perpetuity yield, perpetuity formula is 1 over I, and the historical rate of the stock market is about 10%. So that's 1 over zero point 0.1, you get 10. Um, See, they had pretty solid earnings and free cash flow, but with their debt as high as it is, and interest rates rising. Let's see, minus 129, minus 103. So they are paying down a little bit. Their debt minus 25. They can afford that easily. Um, so what have they done historically? They haven't had a dividend too long, but they could probably increase it 3% a year. Income margins, again, let's lower these a little bit since they have interest payments that are going to be higher. Let's see what four, oh, not there. Let's see what like 4% and 5% look like. Share change. They bought back shares, but recently haven't really done anything. But historically, what are we seeing? 114, 109, 107, 108. I mean, historically, they've bought back shares, so you would think their management would be good and try to buy back more shares. Let's do 0.5%. Discount rate 15. We're calculating a 4.56 as the price. That would possibly get you the return. And right now that's a 12%. It's within 12 decreases. If the price were to decrease 12%, you're looking at a possible discount rate of 15% return given these assumptions. Obviously, I have no idea what's going to happen, but right now, if you're a dividend investor, this could definitely be a company you look at, because, I mean, we're looking at 6% yield. That's pretty great. And again, with their free cash flow, they can easily afford that yield. And it's not looking to be selling too hefty. So definitely a company you should be looking at. Never buy some because I say it, but look at it, get your thoughts together, understand my thoughts, and then process it, see if it makes sense in your situation. Thank you, and I hope you have a good day.